let's pick the top, whatever the top coin is, QLC. I don't know where we are. This looks good. And you'll have trend compression everywhere. Like it just draw trend and you'll see where it's compressed. Like here to here, look, trend compression. Trend compression in this moment dictated, this right here dictated it cannot pass this here, it cannot pass this here, it cannot pass this here, it cannot pass here, cannot pass here, cannot pass here, cannot pass here, until it started that laddering up wedge squeeze against this, creating that handshake moment where it can actually have a larger move up against the compression of trend, which is also just the same thing as the cycle of that now needs to break out of, oh, I don't know where the point is here. Where's the reach? Oh, reach is way over here, haha. Which creates this over here, right? Which is just another form of range binding. This point right here where you get this range bind, and only the effect of time against holding the level can release you of that bind, right? You try to back attack this valley, or actually that wouldn't be the valley you're back attacking. We won't get into the why, but it would be this right here is what you're back attacking. So this moment in time where this bind can be released, and then you can break the level, go over top of it, confirm it, and then have this larger piece of the move up, right? Like that's a pretty sizable move. That's probably like 80% or something. Yeah, it's 60%. Because there's no effect of binding in it. And binding gets released, and when you release binding, you create these uptrends, or these beautiful wedges that we love to look at, right? These beautiful wedges that we love to look at, where you can see same thing from the advanced course when I talk about, again, we've talked about this today, going over top of it, confirming it, and bouncing up and off of it. So if the effect of time has a very specific, and for a very obvious reason too, right? Like time creates trend, therefore time can break trend. Just like price creates levels, therefore only price can break levels. Only the action of what creates the event can therefore then break that same event. So if you have created a level based on a move up or down, then that same move up or down is the only thing that can break that level. You can't move sideways and break a level, just like you can't move up through trend to break it. You actually have to break through trend. And again, you see it everywhere. Even draw any trend on any chart, and you actually can't break it until you move through it. And even that will have other events that fail based off of, accumulation and distribution trends. You trading view, you simply go and going back to back attacking the valleys. And this is a 4 hour, so I'm assuming the 4 hour attempted to complete and failed. And even if this did complete, it was probably going to attempt the daily, which is here or here. But even then, that's fine. This didn't complete, which therefore cycles the move down as a ladder down. Trading view. My God, trading view. I haven't seen it this clunky in a while. Which then therefore just creates a new event that has to, right? Again, we've been trend compressed this whole chart from back here. I'm scared to move my chart. We've been trend compressed since this moment back here, and even in this moment, you can't break straight through it. Even in this moment, you are still trend compressed against failure. In this moment, you are still trend compressed against this failure until you've actually broken through trend, right? And then you can actually complete this cycle of attacking these valleys, but that obviously fails for other reasons, nothing to do with trend. And trend simply arrays out at that point. Right? Trend simply just erased to here, therefore creating the new binds of, oh my God, trading view. Therefore creating the new binds of time, right? Therefore creating this new distribution cycle that it's trying to snap out of, right? Therefore creating just further and further trends that array out further and further and further. Right? Same thing it does here. Same thing it does here to try to back break this level here, which would have also tried to back break this level here, right? So the effect of time is a very specific one on our charts. The effect of time, it's what creates trend. You cannot break trend. You cannot break trend with price. So seeing that on charts is eye-opening, because you'll have these trends that are there, and you cannot break them unless time allows it. You cannot force your way up and through trends. When you do, massive moves happen. Last time I seen that happen was Oaks, actually, on stream live. There was a trend line that it broke over top of, held the trend line straight up through it, and then it went up like another 150%. It was in the first 50% of Oaks's move that day, and it went up 200%. And it was funny because it was on stream and I said like, oh, I'm sure some of you saw this, and it was, and now you'll understand why. And there's a trend on Oaks, and it's like, oh, it's going to stop here for sure. If it goes over top of this thing is gone. And so it did. It took a little while. It took probably about 2 hours of fighting with this trend compression level that was on the chart. Something that would kind of have been like this. This level of trend compression like that, where it had fought with a certain type of trend for, it had stayed in this area for a good hour or something. And then it finally broke over, bounced, and went up 150% because it's trend compression. It's the effect of time. You can't break time with price. When you do, magical things happen. Like, unicorns flying, coins make 200%, those kind of magical things. Like that's what breaking trend does when you go up vertically through it, because it just doesn't happen. Right. So the effective trend is, again, it's created by time, therefore it compresses against time. And the best way I can put it is it's like hitting a steel wall with a pillow. There's nothing you can do about it until you hold through it, and you see it on ARN. And these trends are pretty long-term trends. Like, these are going back from October 2018 to current, and they are still acting as forms of compression in the move currently, because they have not been broken yet. The effect of time has not, like, even in this moment here, where you have the break of this valley, right? Even in this moment here where you go up, how much percentage this, I don't know, this is like some pretty crazy stuff here, like 70% on ARN. Even when you go up 70%, you still fall back within the confines of range binding. Like, you go up 70% and you still fall back in with these legacy binds, right? Like these long-term binds, you still fall back within it, right? Until you can get to this point where you have, again, going back to accumulation distribution cycles, where you have gotten to this point where you have a level that's holding you through the event of trend, therefore completing a cycle of distribution in the cusp to get to that uptrend on the other side, right? You would start from kind of these long-term things, and this is where you have, you see these, like, Bitcoin just broke a level from April. Those levels are there. These trends are all there. It's just, what's the relevance, right? Is this trend even relevant? Like, you're talking about Skycoin going from 150 all the way up to 370 sats. Like, yes, in a Hail Mary situation, this may get hit, but then you'd have other trends too, like this to, maybe Sky's a bad one. There's not very many trends here that are long-term out, but say you had some long-term trend up to 700 sats. Like, it's not relevant information. That doesn't mean it doesn't exist. It means that, some point in the future when we're here, this will act as a form of compression. So you have to mark out the levels at all time points. It's just which ones are relevant. Like, you're going to have a trend like this right here, right? This is relevant in the moment, right? And then you start bringing in your chart, and you start taking in the more local events and not looking at some of these global events, and you have a trend here, right? Each layer of this will act as a form of compression. So each layer will act as, oh, hey, Jimmy, man, did you see that trend from November 18th? And that compounds against scalability, right? So this idea of, if everything were equal to 10 and we had 10 levels on the chart, so this event is equal to, this form of compression is equal to 10 points, or 10% out of 100%, and this one is, and each trend is, and then this one is, and you have all the way up to 100. Let's just say there's one here and here and here, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Perfect. If each of these are equal to 10%, that makes sense. But the human factor dictates that this is maybe 3% of likeliness to happen, as to where this is 28% likeliness, and 28% likeliness when this triggers, because it's not equal to 10, because you'll have more people looking for instant gains and short-term gains. You have swing traders and scalp traders and position traders all exiting here. You have swing and position traders exiting here, or only swing positions here. And then as you scale up, this becomes only position traders. And when this 28% event occurs, which should be 10%, because it's just, we're using equalized numbers, we're using rounded data. This 28% actually compounds the next number, as to where that should have been, I don't know, if this was a case where this was, say, 18, it's 10% less. If this executes and continues moving up, well, this actually wasn't 18. This actually now compounds up to 21 or 22. So it's that effect of compounding nature, as to where the likeliness of these events in the back end are going to become less likely as these events occur. So it's kind of almost like 10% can never exist, because technically you have to have events that occur to scale this baseline that you've created. It becomes the knowledge of accumulation and distribution cycles as to what's happening and why this can hold, right? If this event can't actually happen, to create that into from 18 to 21% unless this gets touched. And this event can't occur unless the effect of time can unbind you against this range to come up into this range, which can't unbind you against that range to get to here. So these become binds on the move as well, as to where maybe this was 28% and this is 10% of people are going to sell against this trend. These things all adjust what's going to happen on the back end. It's constant adjusting variables, because that's the way the human brain works. It's constantly adjusted based on the data that it's getting in the moment, which is creating this beautiful wedge, which I go back to once again, as I will many times throughout this video. This beautiful wedge that gets created, and this accumulation and distribution cycle, where this is trying to end 1 by breaking 2 to create the swing at 3, which will then create this bind here at 4, which will then have to come and ladder here. And these events all have to validate for it to even begin laddering, right? Because that creates a ladder against these trends that are compressing the move. So you're laddering up against compression, but compression is telling you that the move can't continue unless compression completes, which is the effect of time. So it all ties back in a very advanced way, but you have to see all pieces working together in a unison, as to where the effect of time will break the cycle of distribution, completing the 1, 2, 3, 4, 5 of distribution into accumulation. When that cycle of time affects trend and compressions get released, it can swing up against the levels, right? When it swings up against these valleys, you can create an uptrend. When you can create an uptrend, you can have points of invalidation, where if you back target the peak that brought you there, right? Back targeting this point is the same thing as back targeting this point. Flip it either way, I don't care. It's the same thing. There's no difference in these markets up or down. If you have to have a cycle break like this, and you've got this little point here, and it has to actually technically come here to invalidate a laddering, spin it upside down. It's the same thing with a peak, right? This is the same event occurrence, and this is why the science works so well in what I've reverse engineered, because it is equalized events on all sides, and the accuracy is impeccable. It's never wrong. And you can give me a chart and I don't know, KMD, that's new. That's up on the top. Let's look at KMD and see if we can find a distribution cycle.
Hey everyone, how's it going? As you know, I'm now giving out some of this content for free that I was otherwise charging for the past little while. Drop a donation, subscribe to the channel, join Patreon. You'll get access to Discord. Great way. Lots of top level traders in there, people who are doing this for a career every single day. So go to Patreon, join a tier, get access to Discord. Go on Reddit, talk about future of trading, talk about the science of trading, talk about cotton candy, socials, everything you can. Let's help this thing grow. It's the way you guys can thank me for giving out this content for free that I was otherwise charging money for. So I'll leave a Bitcoin address on the screen. I'll leave the Patreon address on the screen. Just do something to help out. Okay, thanks guys. Take care.